Imagine you invest once a month, and over time, you slowly accumulate pieces and shares of Apple, Microsoft, Tesla, Amazon, and hundreds of other top US companies. That's exactly what investing in the S&P 500 is all about. It's one of the simplest ways to build long-term wealth. But when it comes to ETFs, not all ETFs are created equal. S&P 500 ETFs like SPLG, VOO, and SPY. While they may look identical because they all track the same index, there's little differences such as the fees, share price, and liquidity can have a surprisingly large impact over time. Today we'll break down the difference between these three ETFs so you can make a smarter investment decision into the market. And if you stick around to the end, we'll do a calculation of if you invested $10,000 today and $500 a month until retirement in the next 30 years, you'll definitely be surprised to see how much you'll actually earn. But before we get started, welcome back to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the markets. What we discuss here may work for my portfolio, but it might not work for yours. So let's get started. The S&P 500 is an index that was created in 1958 and represents 500 of the largest publicly traded U.S. companies, spanning sectors like technology, healthcare, financials, and consumer goods. Companies like Tesla, Amazon, JP Morgan, and so many more. Historically, the S&P 500 has delivered an average annual return of 10%. That makes it one of the most popular ways to build long-term wealth and a cornerstone for long-term investors who want broad market exposure without the risk of individual stock picking. Rather than buying 500 individual stocks, you can buy the whole market through an ETF or an exchange-traded fund that mirrors the index. That's where SPLG, VOO, and SPY come into play. But they all have key differences, so let's break it all down. First, let's talk about SPY, the big daddy, the OG. It's the most heavily traded S&P 500 ETF. You can see here it was launched in 1993 by State Street and has an expense ratio of just over 0.09%. Its liquidity makes it reliable and ideal for traders or institutional investors, but for a long-term buy and hold investor, the slightly higher fees can erode returns over decades. So it might not be the best deal when compared to other ETFs that we're going to cover here shortly. We can also see here that SPY is trading at $669, which is pretty expensive to invest in, especially if you're new to investing and trying to buy full shares. If you're a beginner investor, this is one that you might want to hold off on and instead invest your capital into one of the other ETFs that are a lot more affordable. SPY is a great ETF for those who want to day trade with shares or with options, as the liquidity is perfect for day trading action. Next up, we have VOO, which is the benchmark for low-cost, long-term investing. Vanguard has built its reputation on cost efficiency, making VOO the ETF of choice for many individual investors. VOO is like a steady workhorse. Low fees, reliable performance, perfect for long-term investors who love simplicity. It's what I've been investing for years in my portfolios as a nice foundation to remain steady through the ebbs and flows of market cycles. As you can see here, the expense ratio is 0.03%, which is one of the absolute lowest expense fees around. And here you can see the ETF price is trading at $615 a share, which is still fairly high comparatively. So for an investor, you may need to buy fractional shares as an easier way to own this ETF in your portfolio. Considering we just looked at the SPY's price, VOO's price isn't that far off. But with these expensive prices, you might be surprised to see just how much more affordable SPLG is. Which leads me to the final ETF that we're discussing today, SPLG. SPLG is often overlooked and flies completely under the radar, but it's the most affordable and cost-efficient way to own the S&P 500. SPLG is also offered from State Street, which gives its investors a low-cost approach versus the SPY that it also offers. With a combination of low expense ratios at 0.02% and a much more affordable, lower share price, Today at $78, it makes it ideal for beginner investors, allowing them to purchase full share amounts with ease versus potentially having to buy partial shares for the more expensive other options, VOO or SPY. Here we can just do a quick comparison to see what the expense ratios are for each and the price. Whereas SPY is great for traders, high liquidity, VOO is great for long-term investors, and SPLG is great for beginners or investors who are a little bit more budget conscious. Now that we've talked about price and expenses, that leads me to the next part to discuss the performance. Looking at this 3-year chart, the lines are pretty much overlapping each other because the truth is there's not much to talk about, as the performance between these 3 ETFs is virtually identical because they all track the S&P 500. SPY is at 84.4%, VOO is at 84.5%, and SPLG is at 84.5%. However, we can look at what the main difference really is, which are the fees and how they add up over, say, the next 30 years. If we invested $10,000 today and didn't add another dollar and figured a 10% average annual return, these are the fees that we can expect. At the end of 30 years, we have SPY with 0.09% fees, which would net us $170,000 with fees of $4,200. VOO at 0.03%, you would earn $172,920 with $1,574 in fees. And SPLG at 0.02%, $173,430 and paying $1,064 in fees. Keep in mind, this $3,000 difference may seem small, but scale this over much larger contributions, like say $100,000 or more. The lower fees compound into much more impactful savings. So now that we've gone through SPY, VOO, and SPLG, let's recap and see what the takeaways are. SPLG is great for beginners or investors who want low costs and fees and low share prices. VOO is great for long-term investors, buy and hold, who are focused on minimal fees. And SPY is great for traders who love to trade options or shares and need that liquidity to get in and out of the markets. No ETF is wrong. It just depends on what your preference is. The key to owning any of these and investing is the consistency of putting money into the market. Whether you dollar cost average, you reinvest the dividends, and staying invested in the market over time through the ups and downs of market cycles, you will build great wealth owning the S&P 500. The good news is you really can't go wrong with any of them. So now this brings me to the last part of the video where I mentioned before what would happen if you invested $10,000 today and $500 a month for the next 30 years until retirement. How much money would you make and how much wealth would you have built? So here we will put $10,000 as our initial investment, 30 years of investment growth with a 10% average annual return, $500 a month in monthly contributions will give us a total in 30 years of $1,205,915 with $190,000 of invested principal. So a phenomenal return. Keep in mind this investment calculation does not include DRIP or the expense fees because this is just based on the S&P 500. But you get the idea how lucrative this index can really be with just a set it and forget it plan of action. Comment down below and let me know if you currently invest in the S&P 500 and if so, which ETF do you buy? So to summarize, SPLG, VOO, and SPY all give you exposure to the S&P 500. But the nuance in fees and share prices can make all the difference of which one you choose to invest in. For most investors, VOO or SPLG will maximize efficiency and minimize costs. Don't forget to like and subscribe. You can check out my other video links in the description down below. And don't forget to check out this video right here, which talks about this secret ETF that's making 18% average annual returns and people very rich.